Okay, excellent. Um, Good morning. I think we have almost everyone on board now for the webinar. Thank you again for attending. Once again, I'll just introduce myself. My name is Michael Aslan. I'm the founder and CEO of Carbon Cap Management. Our company manages the World Carbon Fund. That is a fund that has dual objectives, both to generate strong absolute returns and low correlation, but also to have a direct impact on climate change itself. And I'll take you through that today. The first thing I wanted to say before I begin is that I'm sure that there will be several questions that come out of today's presentation. If I could ask you to go to the Q&A section and enter your question and send it in, type it in, I will then go over those questions after the presentation and try to answer as many of them as I can. So please feel free to send in questions. Right, let's begin. The opening slide is one that is not a happy scene, and there's a quote from Sir David Attenborough on there. It's a picture of Saint-Tropez relatively recently during a wildfire, and we're seeing these fires, of course, more and more around the world. And his quote is very apropos of where we are at in terms of climate change. What we're going to cover today is a quick executive summary, and then I want to take you through the science of climate change, what is happening, what are the impacts, a little bit about the Paris Agreement, the importance of putting a price on carbon emissions, and finally, the World Carbon Fund. So, as a quick executive summary, Carbon Cap is a new environmental asset manager. We do have a Swiss private bank as a minority shareholder. We've recently completed actually a second equity round, so we're well capitalized as a business. We're currently 6 people, but we'll very soon be 8 people, so still a small boutique. Our particular expertise is in climate change, carbon trading, and investment management. Those are our areas of expertise. And really on climate change, one of the key impacts has been emission trading systems. Putting a price on carbon dioxide emissions has been really one of the only successful policies at reducing emissions. These carbon markets are now large and liquid and trade between $1 to $3 billion every day. And that is very interesting because it allows us to deploy capital that aligns with policymakers for carbon removal and carbon sequestration. I'm going to take you through our proprietary research and our academic research on carbon as an asset class, and then finally, I will take you through the investment process of the fund. Our mission is to raise awareness about climate change, which hopefully we will be doing today, and then provide solutions directly related to capping and lowering emissions. The World Carbon Fund is the first of what is hoped to be a family of products all focused on climate change and decarbonization. So let's go through the science of climate change. We see the atmosphere as an unending expanse above us, but if I had a globe at scale, the atmosphere would have the thickness of a piece of paper around a globe at this scale. So it's actually quite thin. And into that atmosphere, we have been pumping more than 100 million tons per day of CO2 and other greenhouse gases for many, many years. Why is that worrying? Well, sunlight comes in. When it hits the Earth, it converts to heat energy, infrared. Unfortunately, some of it is reflected into space, but in the case of infrared, sorry, let me go back there. In the case of infrared, some of it bounces off the atmosphere, the blue atmosphere you see, and as we increase the concentration of greenhouse gases in that atmosphere, it traps more infrared, it traps heat. It's like wrapping the planet effectively in a duvet, and the heat builds and builds, and that has multiple implications. The largest source of this warming is fossil fuels, specifically oil, coal, and gas. And our consumption and burning of those has been on an absolute exponential curve that has followed most closely human population growth. We're currently at 7.7 billion people on the planet now. That is going to 10 billion or more by 2050, and every person has some type of carbon footprint. Charles David Keeling began in 1958 to measure the concentration of CO2 in our atmosphere, which back then was about 280 parts per million, but it has constantly increased annually to now 415 parts per million. This is concerning because we understand the historical relationship on our planet between CO2 and temperature. Now, we know the physical properties of carbon dioxide and other greenhouse gases. They trap heat. When we use ice core data from Greenland and Antarctica, we can build a historical account of both CO2 and temperature on the planet going back 800,000 years. And it fits the hypothesis. In other words, when we see high concentrations of CO2, we see high temperature on the planet. Now, most of these cycles, which are glacial and interglacial periods, have been prompted by changes in the orbit of the Earth, something called Milankovitch cycles. That explains how these cycles move over very long periods, 50,000, 100,000 year cycles. And we're currently now moving very slowly into a cooling cycle. But unfortunately, since the Industrial Revolution and our burning of fossil fuels, we have moved the needle in only 100 years more than it has ever been moved in 800,000 years to 415 ppm. And it's instructive to look at the bottom right of this graph, because when the temperature was at a low during this glacial period in the bottom right, New York City was covered in approximately 2 miles of ice. So that's the downside. And therefore, you have to think about the impact of the upside. With this concentration, one would expect to see a big increase in temperature, and indeed that is what we're seeing. We have seen a large departure, particularly the last 20, 30 years in average temperature. 19 of the last 20 years have been the hottest on record. And quite worrying has been the pattern of actual shifting of the very, very hot days. And I don't know if we use this baseline from 1951 to 1980, what we see as we move in decadal jumps, now 1994 to 2004, and finally from 05 to 15, we see that the right-hand tail of the distribution, which in the investment world, risk lies in the tails. And indeed, that is the same thing with climate change. There is now a very large percentage of extremely hot days. So the average has moved, but the danger lies in these very, very hot days because they promulgate breakdowns in even fundamental infrastructure like road and rail once we move above 35 and certainly 40 degrees C. Last year, there were 364 all-time temperature records set around the planet. So this is not a localized phenomenon. And with each 1 degree rise in temperature, we get two things. One, we get faster evaporation from our oceans and lakes, but the atmosphere can hold much more moisture when we have higher temperatures. And this means when we have precipitation, rain, it comes down faster and far beyond the ability for the natural water table to cope with. If you can see this video, watch the bottom of the screen here. This is in Tucson. You'll see the impact of huge quantities of moisture being released in a short period of time. The natural water table and the storm sewer systems in our cities is simply not designed to deal with this. And the result, of course, is a big increase in flooding. This causes billions of dollars in damages, real damages. Most of this is uninsured damages. This is Appleby, Cumbria in England, 34 centimeters of rain in a 24-hour period. But this is happening globally. The anomalies are increasing at a dramatic rate. The same heat that draws moisture from oceans and lakes does the same to land. That promulgates drought. and it promulgates impact on crops. David Sobel says there's an underappreciation for how big an impact heat spikes can have on crop production. It is estimated that for every day that we have above 29 degrees C, we lose 0.75% of a crop harvest. The number of days now that we're experiencing over 30 in the summer growing season around the world is increasing dramatically, as you saw on that distribution. The combination of food scarcity due to drought, water scarcity due to the redistribution of water means human migration will become a huge political issue. The UN estimates we will have up to 500 million climate refugees by 2030. Where are these people going to move to? But they need to move because it's simply too hot. They can't feed their family. They can't grow crops, and there's insufficient water. This has major military implications, and the military are certainly very aware of this. The heat also causes, of course, the tendency for more fires. One other little known fact is that for each increase of 1 degree in temperature, we get an 11% increase in lightning strike activity. And of course, lightning strike activity is one of the main methods by which forest fires begin. But hot, dry climates lay the groundwork for these blazes to be much, much bigger. We saw terrible loss of both homes and life in California. That was 2018. The fires this year in California have been, and they're still burning now, 4 times greater than 2018 in terms of acres burned. Over 4 million acres of forest burned. Australia, we had massive fires last year, and this year and last year, we saw huge fires in the Arctic. The Arctic is warming approximately 3 times as quickly as the rest of the planet. And when forest burns, it's a double negative impact. Forests, of course, sequester carbon. They suck in CO2 and they release vital oxygen. When they burn, that stored CO2 in the trunk and the branches of that tree are released into the atmosphere, increasing CO2 concentration. That makes things warmer. But at the same time, we remove the sink, the carbon sink of these forests. Again, we've seen yesterday, it was just announced, I did not put it in, that there has been, I think the number was 4 million acres of Amazon rainforest has been destroyed this year, reported by the Brazilian government through their satellite analysis. It's the second biggest year ever of destruction of the Amazon rainforest, one of the biggest carbon sinks and literally the lungs of the world. Globally, these extreme weather events are being tracked by insurance companies. Obviously, some of the losses are insured, most are not, and we're seeing this increase. And this is a very real economic impact, not only social and moral with regards to where the impact is distributed, because it's mainly in the poorer developing countries who are not equipped to respond or be resilient to these changes, but there's real economic damage. This is $650 billion in the US alone. So there is now, has been a big increase in awareness. I think we have reached a tipping point on climate change now, which is wonderful to see. And the Paris Agreement, signed 5 years ago and ratified in 2016, brought together more than 190 countries to agree on limiting warming to either 1.5 or 2 degrees. Where are we today? We have warmed the planet by 1.1 degree, so we're very close to hitting that 1.5 degree threshold. And I think it's very important to understand, why have the scientists told us that we must keep warming below 1.5 or 2 degrees? What's the reasoning behind that? There are many, many reasons. It boils down to the amount of damages that are incurred on the planet. Loss of life and economic damages increases dramatically when we go above this 1.5 degree threshold, and certainly above 2 degrees. I can give you 2 well-known facts. We're currently at 1.1 degrees. At current emissions, we will breach 1.5 degrees in approximately 8 years. That is happening very, very quickly indeed. At 1.5 degrees, we will lose 75% of all coral reefs on the planet. At 2 degrees, we lose 99%. So that puts one small fact in perspective for you. Even more concerning than these direct impacts are the feedbacks that this temperature triggers. Climate feedbacks are that human-induced warming, of warming the planet to 1.5, then causes natural processes on the planet to continue the warming process, even if we reduce our emissions to zero. I don't have time to spend on this. To date, I have read now more than 220 academic papers, 26 books, and I can tell you that the number of positive feedbacks that are out there that are now being triggered is very worrying indeed. To give you one quick example, Arctic sea ice, due to the fact that the Arctic is warming at 3 times the rate of average on planet, that sea ice is declining rapidly. So the summer sea ice extent this year was the second lowest ever on record. Of course, white ice, a white surface, when sunlight comes and hits that, it bounces back into space. But if you melt that ice, that sunlight hits water or land. It then is converted to heat energy, infrared. If you wear a dark jumper out in the sunshine, you know what I mean. A dark surface turns light energy to heat energy. That heat, of course, warms the planet and melts more ice. And we have this positive feedback cycle, which of course is not positive at all in terms of climate change. This has been an area I've studied quite intensively, and it's an area that I believe more research is going to unfold in the coming years to say it is more urgent than ever to keep our warming below these thresholds so that we don't trigger these feedbacks. To put in perspective how big the challenge is before us, if we would have started this process 20 or 30 years ago, we could have made small incremental changes in emissions. We have not. We have simply increased and increased emissions every year. In order to meet the 1.5 degree and 2 degree pathway that you see here, we have to turn the blue line, the biggest supertanker in the world, we have to turn that on a dime and begin reducing emissions at dramatic scale. And that is going to be a huge challenge, but we're seeing more and more countries and leaders rise to the challenge. Many countries have now announced net zero. China, 4 or 5 weeks ago, announced peaking emissions by 2030 and net zero emissions by 2060. Shortly after that announcement, both South Korea and Japan have announced net zero. Of course, the UK was the first sovereign country to announce and put into legislation a net zero emissions target by 2050. So there has been dramatic progress. We're seeing today and tomorrow, the European Council is hopefully going to ratify what the European Parliament has already voted on, which is a 55% reduction in emissions from a 1990 baseline. This is an increase from the current law, which is 40%. So again, wonderful to see this increase in ambition. One of the policies that is being increasingly recognized to be successful at lowering emissions is putting a price on them. Classically in economics, carbon emissions would be called an externality. Because if you build a factory and make steel and you pump out carbon dioxide, it's external to your business. It doesn't cost you anything. But there is a cost, clearly, to the planet. And classically in economics, the way you deal with that externality is you put a price on it. And that means that if you're emitting carbon dioxide and you have to pay a carbon tax, or if there's a carbon market like we have in Europe where you have to buy carbon allowances that allow you to emit, it then means those businesses, those companies have to take into account the price of carbon into their capital allocation decisions. And we do live broadly on this planet in a market-based economy. And a market-based economy respects supply, demand, and price. We may not like that, and we're moving more towards ESG, but most capital allocation decisions look at price. And therefore, by moving a price into carbon, we're seeing a real impact on lowering emissions. And it's been very, very successful. In terms of carbon pricing, there's now 51 initiatives around the world. The yellow bar is the introduction next year of the biggest carbon market in the world in China, covering 4 billion tons of emissions. When that is on stream, that's great progress. But as you can see, it's only 20% of emissions on the planet. So we need to do more. Cap and trade is a program whereby emissions are capped overall. To give you an example, in Europe, emissions are capped at 1.6 billion tons per year. That is how many permits are issued every year, and that amount is lowered by approximately 2% every year. The underlying companies are tightly audited and regulated. If you emit 1.2 million tons of CO2, at the end of the year, you're audited and you must submit to the government 1.2 million permits. If you don't submit them, you're fined over 100 euros per ton. The price of carbon is about 30 euros per ton, so all these companies comply. And this is a very elegant solution to climate change because it ensures that emissions are capped and reduced, but the trading of carbon between the companies is crucially important. It's very important to understand why trading carbon is so valuable. Within that ecosystem of the underlying companies, different companies have calculated at what price of carbon it makes sense for them to switch. They could buy some scrubbers and put those on the smokestacks to scrub out and capture the CO2. But for one company, that might be economic to do at $10 a ton. For another company, it might not be economic to do it at $15 a ton, and a third company might be at $20 per ton. So there are different costs to reduce your emissions. The trading of carbon between the underlying entities, this is the means of communication. That is how they communicate with each other and set a market price for carbon. And that means when we lower the cap every year, someone in the ecosystem has to reduce or stop emitting carbon. The question is who? And the trading of carbon ensures that the company with the lowest cost of making the change is indeed the company who does make the change. And this is the elegance of this policy. We cap and lower emissions and achieve our environmental objective, but we have done it at the lowest cost to society. And that is very, very important. I hope you could understand that. It took me actually quite some time to fully comprehend how this mechanism uses the invisible hand to allocate these permits to achieve this efficiency. But once you think it through, and we have a lot of materials on our website that can explain this to you, you will see how this works. The main method of how companies get their carbon allowance certificates, each certificate allows you to emit 1 ton of CO2. The means is they are auctioned. So in Europe, we have an auction every morning at 10 o'clock. Between 1 and 6 million tons of carbon is auctioned. That brings in substantial revenue for the countries that participate in the emission trading system. The majority of that revenue, not all of it, but the majority of that revenue is reinvested by governments into low carbon and energy efficiency initiatives. So this is a further benefit of this program. None of us like probably taxes. A carbon tax, of course, theoretically could do the same thing, but one would be worried perhaps about the tax receipts perhaps not being reinvested in low carbon or energy efficiency initiatives. Since the program was implemented in Europe in 2005, overall emissions have declined by 1 billion tons per year. This is moving the needle. In a world of 37 billion tons, a billion reduction is moving the needle. And in particular, what we're seeing now in Europe is burning coal is being knocked off the grid in terms of generating electricity. Coal and gas, for the same thermal output to produce electricity, you need thermal output, but coal emits twice the CO2 of gas. And therefore, when the carbon price rises, it makes coal uneconomic. So they're shutting down huge amounts of coal-fired power generation, not because it's moral, not because it's ethical, because it is simply uneconomic. And this is why a pricing tool, in my view, has the ability to reduce emissions at huge scale. And we need scale if we are going to solve this issue. I mentioned that China is launching the world's biggest carbon market. They are opening that to international financial players. Wonderful to see that. Korea has a well-established and growing in liquidity carbon market. There are 2 carbon markets in the United States already. Many people are not aware of this. There's the California market, which is linked with Quebec. And then on the East Coast, there's the RGGI carbon market, which is 10 states on the East Coast. Very exciting. New Jersey joined at the beginning of this year as the 10th state. In January, in a few short weeks, Virginia will be joining as the 11th state. Pennsylvania is looking to join as the 12th state. And many other countries around the world are looking at launching carbon markets. Indonesia, Thailand, the Philippines. Mexico is already running their pilot with their full carbon market launch in 2023. So carbon today trades $1 to $3 billion every day. We expect this to top 10 billion daily within a matter of years as these new markets come on stream. So that really concludes the section on climate change and carbon pricing. And I'd like to take you through now our research into carbon. In 2018, after the sale of my previous company, I spent really a year and a half embedded in deep climate change research. I mentioned my particular interest in peer-reviewed academic research in this area. And after I became very focused on this, I enrolled in the LSE's Economics and Governance of Climate Change program. That is where I was first exposed to emissions trading. Once I learned that carbon was trading such large volumes, I had no idea that this asset class was liquid and quite large. I wanted to collect quantitative data on the asset class. What's the return been? What's the volatility? What is the correlation? Is this something that could be an interesting investment for my personal portfolio? I hired a PhD student from the LSE, and we have now written a full academic paper. The CFA Institute has published a shorter case study of our paper, which is available on our website. So that might be something to look at. Very briefly, we created an index of 4 carbon markets that are liquid and investable. One of the most interesting findings was each carbon market trades a 1 ton of CO2 unit, the same commodity, but these markets are not correlated. This was a very interesting observation, and it means that when you build a portfolio, if you want to own carbon, by building and owning a diversified portfolio, in particular, you lower the risk. Single markets can be quite volatile and risky, but as you diversify, you can see here the risk-adjusted return is much, much higher. That's a key insight. When we combine the markets and built an index of carbon, the returns were quite attractive over the past 7 years. And if you look at it from the point of view of the Paris Agreement being signed in 2015 and ratified in 2016, since then, carbon, you can see, has been an extremely good performing asset. It has been increasing at about 20% per year for the past 7 years, with volatility of about 20%. So it is quite volatile, even when combined in a portfolio. But more importantly, it has shown no correlation to other asset classes, real estate, equities, bonds, and other hedge fund strategies. In the second part of our academic research, we try to make a case for a forward-looking risk premium for carbon. What do I mean? I mean, where will the carbon price be in 10 years? And to do that, we rely on citing 4 very well-respected studies that have analyzed the key relationship, which is inverse between a higher carbon price and lower carbon emissions. Very important to understand that inverse relationship. A high price means lower emissions, and therefore they've calculated what price we would need for carbon in order to meet the Paris Agreement objectives. And that price is about $100 per ton in 10 years. And that means there's a 6 to 10% annualized rate of return over the next 10 years, potentially in this asset class, a forward-looking risk premium. And that's very, very interesting. And that led me to the thesis of launching a diversified global fund to capture this return, to capture this asset class. The original idea was a passive, long-only exposure to carbon. Just buy it and hold it and do that at low cost. What I learned as I built out my expertise is that we believe it's too early for a passive, long-only buy and hold approach. I presented the research at a conference and met the CEO of a Swiss private bank. They are moving towards sustainability, and they led an equity round for our management company. We've recently done a second equity round due to COVID and slowing down of our corporate growth plans. I'm pleased to say it was quite oversubscribed, and we now have substantial cash on the balance sheet to fund our development. After that equity round, we built out the team. Now, just let me share with you some of the key people. My background, of course, is 25 years in investment management, hedge fund industry, building and selling my previous asset management business to a Swiss public company. Colin Hodges has been my partner for 15 years in that previous venture and is our chief operating officer. The two really expert people that we brought on board are first Nigel Felgate. Nigel has a PhD from Southampton. He's been trading carbon and European energy now for more than 16 years. He's one of the largest market makers in the European carbon options market, which is a deep and liquid market. And he brings huge relationships, contacts, but most important, trading skill in carbon. The other important person is Alex Child. Alex has been advising sovereign governments for 5 years on carbon pricing policy and the design of how these emission trading systems should be designed. Many of them have mechanisms, floors and ceilings, or stability reserve mechanisms to control the supply and demand of carbon. And Alex has built for us detailed supply and demand models in each of the carbon markets that we invest in. So the World Carbon Fund targets this absolute return over any 12-month rolling window. We expect to generate a positive rate of return, regardless of if carbon is up or down. So that's quite a tall order, but we think we can achieve it with our investment strategy. And we want to have a direct impact on climate change. We invest across multiple carbon markets. We use mainly futures and options, but we are in the process of registering for physical carbon as well. Interesting, when Nigel joined the firm, I learned that 90% of the players in carbon are the end users. There are electric utilities, steel companies, cement companies, and that means there are inefficiencies in the market because they're not financial actors. And this allows us to deploy capital in very interesting alpha strategies and generate returns that are irrespective of the movements of the carbon price. Quickly on our investment process, as I mentioned, there are significant opportunities in carbon to create alpha, idiosyncratic alpha that is unrelated to the price of carbon. And therefore, we design the fund around these key principles. The first principle is risk management. Carbon in Europe in particular has very high volatility. It has 50% standard deviation. This is about 3.5 times the volatility of the stock market. So when Nigel and myself sat down and said, what kind of fund do we want to build for our investors? We wanted to build a risk-controlled product. We therefore set a risk limit in the prospectus at around a 15% volatility, so about the same as the stock market. And this risk limit is hard-coded and translated into a VAR limit. So getting a bit technical here, but 10% monthly VAR at a 97.5% confidence interval. We calculate this number every day. We report it independently to our independent compliance company who monitor this. So that's the first thing to understand, is that there's this risk limit. The second decision we made was to deploy the risk budget into two very different strategies. So the first strategy is our core long plus hedges. And this is meant to, as we said, we believe there's a secular bull market, but there can be lots of risk along the way. What do I mean by risk? When COVID hit in March of this year, 2 of the 3 carbon markets in which we invest dropped 40% peak to trough, very similar to drops in many asset classes. There was panic, etc. Our risk limits and our risk targets meant that our losses were greatly diminished during that period. And in fact, during that month, we actually had a positive return in that month because of our second strategy. The second strategy is the alpha strategies. This is where we deploy risk to trade carbon options, carbon futures, and there are a number of specific strategies that Nigel has developed over the years to facilitate trades on a non-directional basis that generate alpha. For those of you who are technically minded investment professionals, we can do a follow-up call with Nigel and drill deeper into specifically those strategies. But it's this combination of 2 different strategies in the fund and the risk management overlay that allow us hopefully to deliver our objectives with controlled risk. So we've got a risk budget, 2 complementary strategies. Alex provides the proprietary research within each carbon market. Nigel, as a flow trader, receives a lot of very valuable information by facilitating trades from big utilities, big steel companies who often want to hedge their carbon risk, and that is trade flow that we see. We also now are seeing more trade flow from hedge funds. Other hedge funds will come in, and indeed we can facilitate their trades. So we're a market maker. So we're a price maker, not a price taker, and that is very valuable for the fund. Finally, let me talk about the environmental commitment of the firm. As I mentioned, we want to have a direct impact on climate change. This is achieved through our commitment to use 20% of performance fees each year to purchase and permanently cancel carbon. Once you understand that the supply and demand of those carbon permits is quite tight in terms of the supply, if you take supply out and tear those permits up, that's almost as close as you can get to pulling CO2 out of the atmosphere. We believe it's highly impactful, and this direct climate change impact is in a fund that is not private equity. It has monthly liquidity, which is quite unique. To give you an example, a $5 million investment in the fund and a 10% return would generate 1,000 tons of canceled carbon. That's about 100 people's carbon footprint in Europe. So there can be a direct impact through this. We also believe it's very vital that we provide price discovery and liquidity. Of course, if we're holding carbon in the fund, which we do, that carbon cannot be emitted into the atmosphere. And we're a natural buyer during price falls and a seller during price spikes. So we believe we'll be effectively helping the market, and we actively engage with NGOs and other regulators to promote emissions trading as a solution that can move the needle at scale on climate change. The fund itself is an Irish qualified investor fund. So this is an expert investment fund. It is not a retail fund. It is not a UCITS fund. The fund has monthly liquidity, and therefore you can come in and out monthly, but you must be a professional investor. The minimum investment is 100,000 euros. We have a standard share class, but we also have an early bird share class. This is for the first 50 million. And as I mentioned, we're currently at 34 million in assets. So we are closing this discounted share class in either end of January or end of February. Certainly that will be closed. There are currencies in different share classes. SocGen is the custodian of the assets of the fund. We have no access to the assets in the fund as the management company, and they calculate every month a net asset value per share for the investors in the fund. The fund is annually audited by Deloitte. And as I mentioned now, having gone through building and selling one asset management business, we do have, I think, the ability, the expertise to manage and grow this fund, hopefully quite well. So just closing with, before I look to see if there's any questions, there may be, there may not be. Our advisory board consists of both investment management professionals, but also professionals with expertise on carbon trading, and climate change. Sam Fankhauser, of course, is the director, the most senior person at the LSE Research Institute on climate change, and very pleased to have him on our board of directors. So we do have a couple of questions here. First question is, do you anticipate the Chinese carbon market being tradable for a fund like the World Carbon Fund? The answer to that is I do, but I think it will be some time before we will be trading in the Chinese carbon market. We would like to see the market launch. We would like to see them work out the bugs of the market. And ideally, we would like to see them list a futures contract that is liquid and tradable, so that it takes away counterparty risk and other risks like that if it's traded on an exchange. Second question, are the multi-strategy hedge funds participating material in this market? In terms of fund participation, this is something that we track quite closely. You can get the data. It is reported in terms of the holdings of carbon by funds in particular. It is a category. So this question is, I'm a bit confused as to how there are different prices of carbon credits and allowances, although it is the same value in terms of emissions. If you have a diversified portfolio, would that allow you to purchase these allowances elsewhere and use it as a form of arbitrage? So as I explained in our research, if you look at the prices of carbon in the 4 markets that we looked at in our research paper, these markets are not correlated, even though each market covers 1 ton of carbon dioxide, the same commodity. And the final question is, do you see an opportunity in the VER market with the increase in corporates announcing net zero? And is there a potential credibility and traceability premium? So the first thing to say is that, and I did anticipate this question by having a slide. There are today 3 quite distinct carbon markets. So we, of course, operate in the liquid, regulated, and very large compliance market. It's called the compliance market because the underlying companies must comply. If they emit 2 million tons, they must submit 2 million permits. And this market, big, regulated, and very liquid. The much smaller second market is the voluntary carbon market, which would be VERs, would be one example of those. But there's many projects. These are projects where you click on a website when you book your flight to buy some carbon offsets to offset your flight or your personal carbon footprint. Maybe they plant trees. Maybe it's a carbon sequestration of animal waste that gives off methane. These kind of projects form the voluntary carbon market. That market is important, but today it's small, it's unregulated, and there's no liquidity. The average price of an offset in that market is about $3 a ton. And in the European compliance market today, we have a price of about $36 a ton. So you can see perhaps the price is telling us something about the quality of the offset. The voluntary market is seeing growth and great interest because there are many co-benefits around a project. So they might build a project, do a project to plant 100 or 1,000 acres of trees and calculate the carbon that will be sequestered, but often they will also provide a school or sanitation or clean drinking water in those emerging worlds for the local community. So there's sometimes wonderful co-benefits. The issue is around 2 key things, and it does get quite technical. The permanence of that carbon that is sucked out in the case of trees. If the trees burn down, if someone chops the trees down, of course, then the carbon won't be captured. And there's a number of issues around voluntary, but Mark Carney, former governor of the Bank of England, has now initiated a project to increase the robustness of the voluntary carbon market, introduce standardization, and when that happens and they want to list a futures contract to trade that, that is something we can get involved in. The third carbon market is under the Paris Agreement and the United Nations Framework Convention on Climate Change. Each country submits an NDC, a nationally determined contribution, which is their contribution of reduction in emissions. Some countries recognize the only way they will meet their NDC commitment is by trading carbon between countries. Some countries have bigger natural sinks like Brazil, some countries don't, and therefore in order to meet their emission reductions, they will have to buy and pay for carbon offsets. That market is currently in suspended animation. It is hopefully going to be restarted when they work out Article 6 of the Framework Convention at the COP, which will be held in Glasgow next year. It's a very big year for climate change next year, where countries are resubmitting and hopefully increasing their ambition, and they hopefully will work out that. And then that market will be a third, hopefully big and tradable carbon market. So there are currently 3 markets. We are involved in only one. We think this market gives us 1 to 2 billion of capacity in the fund. But when these other markets come to operationalize and are liquid, that would significantly increase our capacity. So I think that is all the questions. I hope you haven't been bored to tears with this presentation today. I hope you found it very useful.